Hi, this is Chris Ciovacco with Ciovacco Capital Management. In Part 2 of our 2011 Outlook, we will cover some additional reasons to be optimistic about the first half of 2011, as well as some concerns that could derail the bull market. If you want to examine one of the charts that follows in more detail, or if you want to copy down some of the information contained on one of the following slides, you can simply click on Pause. To restart the video, click on Play. During bull markets, it is common for buyers to step in near the 40, 50, and 75-day moving averages, shown in blue, red, and green below. In late November 2010, the S&P 500 was able to hold near the 40 and 50-day moving averages, which supports the bullish case. If the size of the video player makes it difficult to read some of the charts that follow, you can find larger and clearer versions in the December 13th Short Takes post, entitled Risk Assets Responding to QE. Short Takes is the CCM blog. It can be accessed via a link on our homepage. Traders and trading algorithms use numerous methods to monitor the market's risk-reward profile, including Fibonacci retracement levels. An important retracement level for the S&P 500 sits near 1228. As you can see in this chart, the S&P 500 was unable to clear 1228 in the spring of 2010. In early December 2010, stocks exceeded the retracement level, which adds another check on the bullish side of the ledger. The longer the S&P 500 can hold above 1228, the more meaningful the breakout becomes. When bullish or bearish evidence is present in various time frames and on daily, weekly, and monthly charts, it becomes more meaningful. This chart looks at two trend lines dating back as far as 1992. In the lower left portion of the chart, notice how the S&P 500 found support near the green arrows. The same trend line acted as resistance in late 2009 and in early 2010. The trend line drawn from the 2000 tech boom highs acted as resistance in 2006, support in 2008, and resistance again in 2010. In December of 2010, the S&P 500 broke above both major trend lines, which may open the door to further gains in late 2010 and into 2011. Notice how the S&P 500 acted after breaking above the upper trend line in 2006. Parallel trend lines often have importance in the minds of market participants. The thin dotted trend line in this chart may act as resistance. As always, we must keep an open mind relative to bearish outcomes, especially if the evidence provided by the markets changes. This chart shows key S&P 500 levels from a monthly perspective. If the breakout in mid-December 2010 can hold into January 2011, 1315 becomes a realistic number later in 2011. Investor and advisor sentiment can serve as a contrary indicator, especially at extreme levels of bullishness. Sentiment needs to be monitored closely as the percentage of bulls relative to the percentage of bears increases. Other concerns include a possible spike in interest rates and/or higher than expected inflation rates in the United States or abroad. The charts and analysis presented here relate to longer-term outcomes. Corrections are always a part of any bull market. We believe quantitative easing will continue to impact asset prices in 2011. It is important to understand how the QE process works in the real world before making allocation decisions. You can access a series of videos on this topic using the QE videos link on our homepage. At Ciovacco Capital Management, we wish you nothing but success in your personal, professional, and investment endeavors. Have a great day. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decisions.